City Fire Department Pension Fund Investment Meeting. It's October 14th, 2015. It's 5 minutes after 10. I'm not sure, did I mention this is 10:14?
Yes.
Okay. We're at New York City Controller's Office, 1 Center Street, room 530, New York, New York. We need a roll call of trustees.
Mr. John Abner.
Present.
Ms. Susanna Vickers.
Here.
Mr. Antonio Rodriguez.
Present.
Mr. Steve Cassidy.
John Kelly as Steve Cassidy's proxy.
Mr. James Levin.
Vince Speciality is James Levin's proxy.
Mr. Eddie Brown.
John Kelly as Eddie Brown's proxy.
And Mr. John Kelly.
Present.
Mr. James McGowan.
Here.
Mr. John Farina. Mr. Paul Furrow.
Here.
Mr. Thomas Fillen.
Here.
Commissioner Douglas White.
Here.
I have 24 votes in the quorum. We may start the meeting.
Public agenda.
Okay, thanks very much. We're going to quickly go over August. August was not too pretty, so we'll try to go over it quickly. It's in the flip book here. Start on page 27. If you look on the left column, you can get an idea for what kind of month it was. U.S. market was down about 6%. The developed international market was down about 7%, page 27. And the emerging markets was down 9% in 1 month. Not a good month. You can see that the credit end of the bond market was off as well. As you recall, there's all kinds of consternation about the slowdown in China. China letting its currency devalue by 3%. They later came back and had some soothing words that calmed people down about their currency. But the issue of China's growth has persisted. We have seen the market continue to sell off. If you turn to page 29, this is a month after the results you're going to hear, but I'll just go over it quickly. You can see that the U.S. market was still selling off 2 to 3%, and the small cap side was selling off even more. That's where valuations were higher. The developed market selling off at the high end of that level, 5%, but the emerging markets, on a relative basis, we're not going down as much in September. We've since seen a pop in October as all of this slowness seems to have convinced the Federal Reserve not to be as aggressive with raising rates. The betting on a rate rise happening by the end of the year has reduced considerably. That has weakened the dollar. Interest rates are at a low level, now just about 2%. So we continue to skate along on very, very modest expectations in a global growth environment that is shaky at best. If you turn to page 39, you can see how we did in August. Remember that August numbers were down 6% for the equity markets. The total fire portfolio, the third column in, gross of fees was down 3.18% for the month versus a benchmark of 337. So we outperformed slightly during the downturn in August. You can see as you look down the red and green where we underperformed and outperformed during the year, and there are many areas, particularly in the equity markets, where we were outperforming. I'm happy to, I should talk about volatility. If you turn to page 18, you can look at volatility. Now we've got this chart going all the way through October 6th. You can see the spike in August up to 40. We hadn't been at those levels since 2011. There was really a lot of anxiety in the markets. This is, of course, the implied volatility, the S&P 500 contract, which shows you the angst or risk assessment in the market. That is sold off considerably. You were at the 19 level on the 6th of October. I think you've come down even further since then. So we're settling out. However, it's earnings season. The market is, rather than all stocks going up and down together, the market is, everything's moving in different times based on earnings. That's good for active managers. They position themselves well relative to the market, and everything's not going up and down together. It gives them a chance to show their stuff. So we're hopeful as we go through an environment like this that our active managers will be able to differentiate themselves. It's an environment that should benefit them. With that, I'd be happy to take any questions. We do have a special presentation from Goldman Sachs for the educational session, but if you have any questions on the month or the markets before our strategist comes in, I'll be happy to take. Okay, hearing none, why don't we bring Goldman in? Goldman, at least if you could introduce your team and we need to spell everybody's names for the
Yeah,
record.
fantastic. Thank you. I'm Lisa Rotenberg. I'm a managing director at Goldman Sachs Asset Management.
Could you speak up just a little bit?
Oh, sure.
This is a terrible room, I'm sorry.
Thank you. Thank you for highlighting that. I'm Lisa Rotenberg. I'm a managing director at Goldman Sachs Asset Management. I've been at Goldman for 21 years, and we really appreciate working with the New York City Fire Board. On my left is Matt Weir. Matt is also a managing director. He's our senior strategist in our investment strategy group. He works with institutional clients on strategic and tactical asset allocations and focuses on the best opportunities in global equity markets. Needless to say, he's doing the heavy lifting today, and he's been with us since 2003. Joe Karwowski on my right is a vice president and is also a relationship with the New York City Fire Pension Fund. You may remember that Joe and I attended the United Firefighters charity golf tournament, and Joe was the one who won the longest drive. So,
Just put me on the spot.
so in terms of spelling, I'm Lisa, L-I-S-A, last name Rotenberg, R-O-T-E-N-B-E-R-G.
And spelling is M-A-T-T-H-E-W, last name Weir, W-E-I-R.
Spelling for me is J-O-S-E-P-H. Last name is K-A-R-W-O-S-K-Y.
So just a brief introduction. We'd like to thank the Fire Board and the Comptroller's Office for inviting us to present today. We're going to focus on our global macroeconomic views and our outlook. Importantly, before passing it on to Matt, I think you know that the macro outlook has been in a period of market volatility and economic uncertainty, particularly coming out of China and Europe. We don't think these risks will derail economic growth, particularly in the United States, where we think growth is preeminent, and this is the world's preeminent economy. One last thing, we're Goldman Sachs Asset Management. We're on the fiduciary side of Goldman, and all we do is manage money on behalf of our clients. You're one of our clients, and we appreciate your confidence in us.
Good. Thank you, Lisa. So thank you very much for having us. We're honored to be here. As Lisa mentioned, clearly over the last couple of months, there has not been a shortage of things for investors to be concerned about. In terms of how we see the world, we always start from what is the most important factor driving global markets, and we think that the U.S. economy is absolutely the most important factor that all investors should be focused on, even despite some of the risks that are coming from overseas. The way we get to that conclusion is when we look at page 2 in the handout, there are 3 general areas of factors that will assess global markets on. First, economic. Secondly, financial. Thirdly, from a long-term perspective, human capital is the primary driver of global GDP and GDP for any single economy. When we run this analysis for the US, for the Eurozone, for Japan, for other markets, we find that the US economy, in addition to being the largest economy in the world, is the most preeminent economy from a growth standpoint, and we see the gap between the US economy and the rest of the world actually widening. And we think generally this is good news for the investment outlook. So what we are going to do this morning is just walk through some of these factors so you can understand exactly how we get to that conclusion, and then we'll conclude with some remarks about equities and fixed income and some of the risks to our views. On slide 3, we'll start by looking just at where growth globally has been over the last decade or so to illustrate just how much the U.S. economy has outperformed the rest of the world. First, on the left-hand side of page 3, you can see that relative to the end of the recession in 2009, the U.S. economy has grown by a much larger amount than the Eurozone and the Japan, the two other large developed economies of the world. U.S. GDP is up a cumulative 13%. That's much higher than the 5% we've seen in the Eurozone, also higher than the 10% we've seen in Japan. It's also the case that when you look prior to the financial crisis, and since the peak of GDP, you can see that the U.S. is the only economy that stands at a larger size today than its peak in 2007. In fact, the U.S. economy is 8.5% larger today, whereas the Eurozone and Japan have yet to regain their peak levels, even though we're 8 years beyond. So from that perspective, we see a lot of strength in the U.S. economy and momentum that we think is going to continue. On page 4, we also want to compare the U.S. to emerging markets. Emerging markets have been the fastest growing economies for the last couple of decades. We continue to think emerging markets will grow faster than the U.S., but importantly, the gap with which emerging markets have grown faster than the U.S. has fallen, and we think it's going to continue to fall. So on the left-hand side of page 4, we're showing the gap between emerging market GDP growth and U.S. GDP growth, and you can see that whereas in 2007 the gap in GDP growth was above 6%, now that gap has shrunk to just over 2%, and we expect it will fall below 2% by the end of this year. The other point we'll make about emerging markets that we think is important, over the last decade, we have seen a significant amount of interest across investors in investing in emerging markets. A key reason has been that emerging markets have grown faster than the U.S. economy, Europe, and Japan. A couple of things. First, we would note, and we would want to caution investors from investing solely on the basis of GDP growth. Historically, we have found that that hasn't been a profitable strategy. And secondly, despite the fact that emerging markets have grown faster than developed economies, emerging markets still remain very poor economies. On the right-hand side of page 4, we illustrate this by looking at the amount of GDP each of these economies produce per person in their economy. You can see currently that the GDP per capita for the U.S. is about $55,000. Compare that to China, which despite the large amount of growth in the last couple of decades, stands well below at $7,600. So there's a very large gap between the U.S., China, and other emerging markets. I also think it's interesting that if you look back in 2007 and see how big this gap was then, despite the fact that China has outgrown the U.S., the gap in GDP per capita has widened. Whereas in 2007, the gap was $45,000. The gap today is $48,000. Now, a positive for emerging markets is, well, this represents a very large opportunity. They have significant room to develop. But until then, we tend to favor the developed markets at higher GDP per capita because those economies are much more stable. Now, putting this all together from a growth perspective on page 5, looking at our views where growth will end up at the end of this year, we see developed market growth, US, Eurozone, UK, Japan, growth actually accelerating this year, whereas growth in the emerging markets is decelerating. This is important because, as I mentioned on the prior page, this is in contrast to what we've become used to over the last couple of decades, and something from an investment perspective we want to keep in mind. Big picture, I think the most important takeaway is that global growth we expect to be about the same this year as last, and probably similar next year as it is this year. So from an investment perspective, that we think is something encouraging, that recession risk is relatively low and GDP growth is likely to continue. On page 6, why don't we move from economic growth and focus on what we think is the financial preeminence of the United States. We would point out that despite the fact that the U.S. recovery since our recession has been slower than normal, earnings per share growth for U.S. corporations has been remarkably fast and actually rivals that of earnings growth in emerging markets. And in fact, the only reason emerging markets have grown their earnings faster than the United States since the crisis is due to earnings growth coming from the Chinese financial sector. I highlight that because that's probably what we would say is the key risk to the global economy. China's economy has become very reliant on debt growth. Banks have been growing their balance sheets. They've become much more leveraged. This is very similar to what was happening in the US prior to our financial crisis. So we would acknowledge that emerging market earnings growth has outgrown the US. From a quality perspective, we would argue that the earnings growth has been better in the US because our financial sector and households have actually been delevering. And so this earnings growth has come despite the reduction in debt that we've seen since the financial crisis. The third and final leg of how we've come to the conclusion that the U.S. Is home to the best investment opportunities is when we look at the human capital. I mentioned earlier that the primary driver of GDP growth over the long term is human capital, and specifically the productivity of your labor force. We would note that U.S. productivity is much stronger than that than the rest of the world. On the first exhibit on page 7 on the left-hand side, we're showing the amount of output per worker. You can see that U.S. workers are much more productive. They generate much more output per head than all other economies in the world. And even over the last decade, as U.S. growth has been disappointingly slow in this recovery, productivity has grown for our workforce. So our workers have become much more productive and almost double the rate, it has produced double the rate of productivity growth than you've seen in the rest of the developed world. On top of that, one of the key themes we're looking at is how manufacturing is coming back to the U.S. after a couple of decades of leaving the U.S. When China joined the World Trade Organization and opened up its borders to more business, you saw a lot of U.S. corporations move production overseas, and specifically to China, where wages were much lower. Since then, as you've seen more demand for China labor grow, wages in China have grown such that today it's not actually that much cheaper to produce in China than it is in the US. Consequently, we're seeing companies increasingly move production to the US, Canada, and Mexico than increase their production overseas in Asia. We think this is a very big advantage for US corporations. We also know that another reason U.S. corporations are becoming very competitive is the cost of energy in the U.S., thanks to new production techniques, has reduced our cost of energy relative to that of Europe and in Asia. So our corporations in the U.S. can be much more competitive globally because their cost base has become lower relative to the rest of the world. So putting all of this together, we conclude from an investment perspective that the corpus of any investor's portfolio should be based in U.S. assets. And looking at the asset allocation of your fund, we note that you do have the majority of your public equities in the U.S., about 2/3 versus 1/3 internationally. That is consistent with exactly what we advise our clients in terms of the share of public equities being allocated to U.S. Versus non-U.S. Equities. So consistent with the analysis that we've presented so far. Why don't I spend just a couple of minutes on financial markets, both equities and fixed income, and then we'll talk about some of the risks to our views. On page 9, turning to fixed income, equities, we would note that the length and the magnitude of the bull market we have been in since 2009 has been striking, in that it has been longer and larger than many bull markets that we have seen historically, but it is not without precedence, and we don't think that the current bull market is likely to die just of old age. In fact, when we look at bull markets going back to World War II, we have seen 2 bull markets last longer than the current bull market in the U.S., and 3 bull markets post an even higher return than we've seen so far. Since the trough in the equity market in March of 2009, U.S. equities are over 200%. It has been a 6-year recovery, but we note that the bull markets that began in 1949, 1982, and 1990 all produced higher returns than we've seen so far. This is the table on the right-hand side of page 2. And 2 of those bull markets, 1949 and 1990, lasted longer. One bull market lasted considerably longer, implying that we could have even 3 more years left in the current bull market. So we don't think that just because this bull market has been strong and a bit longer than others, that alone is reason to believe this bull market will end. We think GDP growth will continue in the U.S. We see inflation as remaining low. We think the Fed is likely to remain lower for longer. One caveat to that view on U.S. equities, briefly on page 10, is that even though we don't think the bull market is likely to end, that doesn't mean that we are not going to see some corrections in equities along the way. Peak to trough, we saw the equity market decline by about 12% over the last couple of months. That felt like a very significant move. We think it felt like a very significant move primarily because it's been a while since we had seen a 10% correction. Now, for an asset class with 15% volatility, a 10% correction is not all that unusual, but we hadn't seen one in over 4 years. So we think that's especially why the recent decline has been uncomfortable. Typically, you tend to see a decline of 10% or more every 2 years or so. Moving to fixed income on slide 11, the point I'd like to make is simply to provide some historical context to the current low level of interest rates. One of the common points we hear from investors and market commentators is that interest rates are low and there's only one direction for them to go, and that is to move higher. Well, when you look at the historical distribution, that is probably a good conclusion, but we don't want to ignore the fact that there have been historical periods where interest rates have remained low for a long period of time. On the left-hand side of page 11, we would point out that if you go back to the 1940s, following a very deep recession, the Great Depression at that point, interest rates remained very low for a significant period of time. In fact, the U.S. 10-year Treasury yield stayed below 3% for over 20 years and below 2.5% for over 12 years. In the current episode, we've seen the 10-year yield in the U.S., which currently stands just above 2%, remain below 3% for 98% of the time over the last 4 years. We're not saying that a repeat of the 1940s is likely. We just want to point this out so that from an investment perspective, we're familiar with the wide range of outcomes for interest rates. The only other point I'll make with regards to fixed income is if you look internationally, interest rates are also low, and there is also precedent for U.S. rates to remain low for a very long period of time. In Japan, for example, their 10-year yield has been below 2.5% for over 18 years, since 1997. So U.S. rates may remain low for a considerable amount of time, and that's just something we want to make sure investors are also aware of, and not just hearing that interest rates absolutely need to rise from their current levels. So in conclusion, on slide 12, I think the key takeaways for what I've said are fairly clear, that we don't think the bull market is over. We think the U.S. economy is preeminent. We advise investors that despite the fast return, or the significant return since 2009, we advise investors to remain invested in U.S. equities. We do think interest rates are more likely to rise than not. We think the Fed is going to raise interest rates at some point in the next 6 months, but we think that interest rates will only rise very gradually and remain at historically low levels, and that there isn't, though, a shortage of risks to our views. I highlighted China as being a risk to the global economy. I would also highlight that the Federal Reserve tightening interest rates could also be a risk. While we think this is probably one of the best telegraphed Fed tightening cycles in history, markets may also still be volatile once the Fed gets started. Other risks include Europe and the potential that the European economies don't continue along the path of much needed economic reform. And then, of course, geopolitical hotspots, whether it's Syria, Iraq, Iran, Israel, Russia, Ukraine, various hotspots within Asia, including North Korea, and China disputes with neighbors over islands. There are a lot of geopolitical risks that are very hard to handicap, very hard to, I would say near impossible to diversify out of a portfolio, but these are, of course, risks that could derail the views we've discussed in this presentation. So with that, why don't I ask if there are any questions or clarification based on what I've said?
Any questions?
One more, while people are thinking. On page 5, you've got the economic growth. You show the run rate for 2014, and then you've got your 2015 forecast range.
Yes.
And while the talk about emerging markets slowing down and so forth was, looking at it on an aggregate basis, when you pick apart the BRICS, which you guys have made so famous, there are really two BRICS that are falling rapidly.
Yes.
And, one BRIC that is wobbling, that there's been a lot of talk about, but it's still growing at multiples of
Yes.
the Western world. And you've got India that's actually accelerating. It's accelerating more than any other market that you show. Are we at a period of time where the fundamental outlook for those two countries is different and more indicative of what we've seen in the past, and do earnings multiples fully reflect the lower growth in China?
Yes, yes. So, very good question, because one of the concerns we've had for investors when they look across countries is they'll tend to group emerging markets as one homogeneous group and treat them the same. There is a lot of divergence across emerging markets, across various factors. Here is one factor: GDP growth. India's economic growth rate is accelerating. India, I would argue, is on a much more stable ground than any of the other emerging markets, certainly the other economies in the BRICS, primarily because from an institutional standpoint, meaning the Indian government is more stable than the other economies. It's also the world's largest democracy. So from an investment perspective, we do think India is probably the best positioned. Whether the market currently discounts that good news, until recently we had been advising clients to overweight India to some degree. We recently took that off because India had outperformed other emerging markets to some degree during this sell-off over the last few months. Currently, it's something we're taking a close look at because as emerging markets tend to get sold off as one homogeneous group, that could eventually present another opportunity for India to be an attractive overweight candidate. In terms of China, you're absolutely correct that growth in China, despite all of the concern about slowing growth, we need to keep it in perspective that growth of about 7% this year is multiple